So in the last video, we were looking at the income statement. Now we are going to look at how we can analyze the figures on the income statement. How do we analyze it? We use something called ratios. So let's look at some of the figures and let's analyze them and actually learn what they mean. So the first thing we're going to be looking at is the gross profit margin, or GPM. Now the gross profit margin tells us how much of our gross profit comes from the revenue that we have earned. So from the revenue that we have earned, how much of that is profit, or gross profit for that matter. So you know that gross profit is revenue minus the cost of sales. So the margin will show that as a percentage. So how do we calculate it? Gross profit divided by revenue times 100. So if we go back here to our previous example that we had shown you in the previous video, we have our gross profit figure over here, which is 800. We have our revenue figure up here, which is 1,000. So all we do is we plug in the numbers. So gross profit is 800. Our revenue is 1,000. Multiplied by 100. Oops, excuse me. So, to do that, obviously, let's see. 8 out of 10. So that is 0.8. 0.8 times 100 is 80. And that is your gross profit margin as a percentage. Always make sure you add the percentage at the end. In the exam, if you do not mention the percentage, you are going to get a mark deducted, and that's a silly way to have a mark deduction. But as you can see, it says that 80% of our revenue comes from the gross profit. So that means at the 1,000 that we made, 80% of that is gross profit. Now we do the same thing, only this time it is for net profit. Our net profit here in this example is 300. So we take our 300 and we do the same thing as we did with GPM. We divide it by 1,000. Same thing. So this is our GPM. Let's now do NPM, which is 300 divided by 1,000 times 100. Same thing. 3 out of 10 is 0.3. 0.3 times 100 is 30%. So your net profit margin is 30%. So what does this tell us? Now that we've calculated it, what's the point of these figures? What's the point? Well, let's look at each one. So we know that with the cost of sales that we had made, we had still have 80% profit. That means the cost of sales is not very high, which is good, because then you earn a lot of gross profit. If you look at the net profit, it's at 30%. That's still very good, because what is left after that, it means that the expenses was more than enough to cover from the gross profit. So next year, if the figures change at all, it'll most likely either be from cost of sales for the GPM or expenses for the NPM. So this figure tells us that we're at a healthy profit regardless of the expenses and the cost of sales. And this tells us that 80% of our revenue, so it will be profit. Gross profit, sorry. So these are what the ratios show. And obviously, as you can see, these are both very healthy figures. In fact, this one is very healthy. This one is healthy as well. At the end, you can even do something called a retaining, as you would the gross profit and net profit margin. But you can. But at the end of the day, if that remains positive, it just means you can carry more money forward next year. So these are the ratios that we can check for profitability. And as you can see, both figures are very profitable. And both figures reflect a healthy business activity for the year 2023. And the only other thing that I would add is that you'd compare it with either the previous year or the next year's financials in order to say whether or not it is doing better or worse if you want to do a comparison. But yeah, that is profitability ratios right there. In the next one, we'll be looking at statement of financial positions.